we are just discussing, deliberating, ideating, and also debating is that why are FIs not investing in India when the world, in a sense, is falling apart? And what will it take for foreign institutional investors to make a comeback? Look, investors, when they come back, when they see safety of capital, which is there in India, when they see return potential, which is a function of earnings as well as valuations. So what will it take for institutional investors to come back to India, and what factors could be at play? And to discuss that and to take that point forward, it gives me great pleasure now to bring on board Vivek Paul, Head of Portfolio Research, with the largest investing finance firm in the world, BlackRock, and he of course represents BlackRock Investment Institute. So BlackRock is the largest, am I right?
Yes, asset manager in the world, correct.
So what does the largest fund has to say about India?
Structural opportunities are sizable in India. So if we were thinking for anybody with an investing horizon 5-10 years out, we would be building portfolios today using our core IP where you'd hold a greater allocation than a benchmark weight. And that's true for the bond market, that's true for the equity market as well. And that's a function of structural dynamics being positive for India, right? There's an important topic to have about the cyclical, and maybe we'll come to that later. But on the structural side, the demographic sort of forces underpinning India are really strong. Most of the developed markets, China, are going to experience a shortfall in working age population over the coming 20 years. India is going to experience a big gain in working age population in the coming years. And you think about the geopolitical dynamics that we're in now, a multi-aligned country such as India is likely to benefit from that sort of environment more in the future.
But Vivek, India has always been a great long-term story, right? I mean, since the formation of equity markets or, what have you, we've always been that 5 to 10 year story. In the near term though, from the COVID lows, yes, everyone saw that K-shaped recovery come in. The whole world did well, so did we. What has gone wrong in the last 6 months?
Well, I think in the last 6 months, this is where we've got to kind of think about the cyclical dynamics as well as the structural. So clearly, there are some elements of global uncertainty. We alluded to that earlier with regards to changing geopolitical dynamics, changing macroeconomic policy. Tariffs, of course, are a large part of that. That has contributed to uncertainty. But also in terms of the cyclical story, the idea of consumption being a little bit more challenged for a period of time, the idea of liquidity being comparatively constrained in India, you will see these oscillations. That's natural cyclical dynamics. And so we can't ever kind of assume that we will never see cyclical dynamics. I think that's been a large part of the story. But I think as they unwind, I think again, attention will be focused on fundamentals. And that's where I would see international investors wanting to tap into the opportunities in India.
What about concerns regarding the earnings slowdown, which of course is cyclical in nature, but valuations, dollar returns, taxation?
Yeah. Well, valuations is an interesting story. So I think this is where distinguishing between the cyclical and structural is really important. Right? If you were to look at current price earnings multiples and compare them to the past, it's not obvious that it's cheap by any measure, right? And people have been talking about that being expensive. But actually, if you think about things in a slightly different way, if you think about the risk premium associated with Indian stocks, I would argue that's not particularly expensive in a historical context. And the reason why I get a different answer for that story than the other one in terms of price earnings metrics is taking into account future earnings growth, taking into account the future path of rates being different from the past. I actually would argue that on a long run basis, particularly in large caps now, it is not the case that Indian equity are particularly expensive. And that's part of the story for us as to why we think on a structural horizon there's an opportunity.
Okay. So if one has to really talk about your preferred markets for 2005, at the beginning of the year when we spoke to some of your colleagues, the call was long US, don't move out of US 10-year, stay diversified and have a reasonable exposure to Europe, gold and other emerging markets. We are in middle of Feb now, or beginning of March now. Has the view, which was long US equities, has that view changed considering there are a lot of factors which are at play right now, and secretly and silently also US markets have also started correcting?
Well, so the first point to make is that long US equities continue to be where we are. And 2025, I think, right? Rather than 2005. 2025, I'm very good at 2005 predictions if you want that. Now, 2025 is a story where we still think that the US will play a positive role and we're still long US stocks. But as this year has developed, we've seen some sizable shifts that, frankly, I don't think anyone was expecting. Let's take Europe as an example. Right? There's been some structural dynamics in Europe, which I think are unprecedented in the recent past, and that's part of the reason why we've recently kind of upgraded our sort of risk call on Europe too. So I think the story would still be one where it's risk on, and US will do well. But I think we shouldn't just look at the US now, is kind of one point I'd make. And then you mentioned also the 10-year. So actually, the call that we'd make now is for the long end of the yield curve in the United States, we'd be a little bit more cautious on the long end of the yield curve than we've started the year.
Can you break long end for our viewers? What does long end mean?
Sure. So if you're thinking about sort of 10-year and beyond maturities, we would see, because we've seen a material sort of decline in yields more recently, we think that when we get towards the end of the year and beyond, we will see yields at the long end having some upward pressure. Because if you take into account all of the story that we're talking about, yes, there's more growth concerns in the near run in the US than there were at the start of the year. But at the same time, the inflationary pressure and the backdrop that we've been talking about isn't going to go away anytime soon, right? And all of the macroeconomic policy uncertainty that exists at this moment in time to do with tariffs, that's all upward pressure on inflation in the long run. So we would anticipate that being a story for the rest of the year.
I have just one follow-up question. Allow me to just take that point slightly forward, and I'll just be the devil's advocate. Just complete devil's advocate. I'm going to challenge whatever you just indicated.
Of course.
I'm just challenging it.
Yeah.
US markets have given away all their gains, which is that the S&P has gone back to the levels of November. So the welcome back Trump trade is over. Volatility in US market has started going higher. The fiscal deficit in US is a concern, and tariffs in the short term will ensure that growth will get challenged. The US economic data, which has just come out last week, which is the data in terms of the new jobs which are getting created, the number of unemployed labor force data, all that is indicating that US economy is slowing down. If economy is slowing down and tariffs are coming and inflation is not going to go down, then why that market at all?
Okay, great question. You would also, so the points you've made are well taken, and that's part of the rationale as to why we've seen a bit more of a sideways movement in the United States. At the same time, artificial intelligence is a structural megaforce that is transforming economies. And in the last month or so, we've seen enormous global sort of advances in that technology space. That brings adoption of this forward. And some of the best companies in the world placed to profit from that exist in the United States. So I think you're right to kind of call out that the macro picture has some more challenges maybe than we would have thought a little while ago, but at the same time, some of those big structural themes that transform the global economy, still, the US is really well placed to take advantage of those. So I think we've got to consider all of these dynamics in the round. And some of the points you made earlier, look, I mean, we have had a view that inflation pressure will exist in the United States even beyond the last couple of months. So we already took that into account in our forward-looking stance in the United States.
Tell me, Vivek, is this entire cyclical shake-off all sort of drawing down to tariff uncertainty?
When it comes to the US in particular?
US, India, China, because each market is a relative play versus the other, right, eventually?
Well, I don't think, I wouldn't put it all down to this, right? I think the points made around comparative growth slowdown relative to where we were in the United States, that isn't to do with tariffs. That was kind of a naturally occurring sort of...
but tariffs will have a big impact on the US.
And I think that's a great point, that this is now about sort of investor confidence and sentiment about the future. So in that regard, the uncertainty of which tariffs contribute a large part play into the idea that there might be greater uncertainty in the go forward as to where will this all kind of pan out. And in general, greater uncertainty means that risk sentiment is going to be a little bit more challenged, right? And so I think there is definitely that story. But again, let's kind of put it in the broader context. Let's go back to Europe as a case in point. Like the gains seen in the European markets have been sizable, and so I think yes, there's greater uncertainty, but in some places that actually is broken out on a positive.
And since you did talk about AI and how the world's biggest AI players are in the US and thereby they stand to benefit, where does China fit into the puzzle now, especially with DeepSeek and all the way hearing about the news flow from China?
Well, I think in the near run, that's part of the rationale that we'd give right now as to why we have been overweight for the last few months with regards to China. There's a near-term story where the markets are looking at the tech space in China a little bit more, the advancements and efficiencies that we've seen there, and that's part of the rationale. It's a large part of the rationale as to why Chinese stocks have done comparatively well in the recent years, so in the recent months. So I think that's definitely part of the story. But then when it comes to, we were talking a little bit about the structural opportunities, right? And this is where, if I think about the near run and the China versus India dynamic, for instance, we're a little bit more kind of positive on the China story because of this. When it gets to the longer run, that's where we prefer the Indian sort of opportunity.
So China is just a tactical play, is what
China
you're
is a
saying
tactical
right
play.
now.
But Vivek, at least in the short term, medium term and long term, what are your preferences in terms of the markets? We got your take on the US, even you touched upon Europe, and even India is a structural story is what you're highlighting. But at least in the short term, a bit of a U-turn, what we are seeing in the US markets, you're still overweight and you believe that in the short term, these are the places to be in?
Yeah, so let's be clear about what I mean by short term. 6 to 12 month story. If you're investing for that horizon, we would still have a positive bias towards the United States. Now, does that mean that there could be some uncertainty and market correction in the next days and weeks? I mean, there undoubtedly could. But if you're investing for the next 6 to 12 months, our view would be, for the reasons we've mentioned, there is an opportunity that continues to exist in the US. That's what I'd say now.
And the other thing that even Aisha was discussing is the AI theme. We are debating about the fact that between US and China, there's a quite a competition going on, that who's going to win the AI battle. But with respect to the emerging market economies, and especially India, there's a concern that AI can definitely impact the Indian IT majors. Give us a sense that what's your reading, that how these emerging markets can actually participate in the AI race, and what is the likely impact on various sectors, especially the IT?
Yeah, so I think for IT, I think a large part will be how those companies who've benefited from the past wave will adapt their practices to benefit from the next wave, right? So you can see that, for instance, some elements of the traditional sort of services dynamic with India, there's an element where there could be some challenge to that. The idea of, for instance, outsourced call center dynamics or whatever else it might be, maybe that's more challenge when it comes to the benefits that AI could offer. But for those companies who can pivot their operations to take advantage of that, for those companies for thinking about, let's broaden it out, think about data centers and big announcements in this country around that. So there are sort of ancillary dynamics with regards to profiting from the AI wave that India can very much profit from. Whether or not it's the traditional companies who profit from that depends a little bit on their operations, how they shift them, rather than anything else. But I think the structural opportunity continues to exist. It might not be the same as it was before.
Okay, so let's start focusing on risk versus reward now. I may like India in the long term, but valuations are above averages. I'm not going to make a return, right? It's like saying I'm buying gold at the price of silver. Where do you think right now, if somebody is looking for stable returns but low volatility, what falls into that bracket for next 12 months? Higher returns but high volatility, because the world would be volatile. So if you have to, let's say, classify, which is what the work you do, I've seen your work, classify based on risk horizon and time horizon. So if I keep the risk horizon as low volatile and high volatile, what would fit in the low volatile bucket? What would fill in the high volatile bucket?
Okay, a great point. But I just want to kind of correct one thing that you said just at the outset. The valuation story that I would argue is actually still, I don't think it's as expensive in Indian equity for India. Over when I take a broader kind of lens and look at the risk premium dynamics, because as I said, the markets themselves are evolving. Earnings will be different in the future. Rates will be different.
Can you explain that before we get to this basket? Because it's crucial for us to understand that how foreign investors look at valuations. Because I'm tired of reading reports which say India is expensive.
Okay.
Every morning one mail comes. Your mail doesn't come, but everybody else is sending me this email.
And you can see why people draw that conclusion, right? And it's I'm not challenging why people might draw that conclusion. You look at price earnings multiples, you compare them to the recent past, and you see they're higher.
Okay.
Undoubtedly true. But What are price earnings multiples representing? Well, they're representing potentially relative to historical earnings if you're using trailing earnings as the base. If I were to try and think, well, what are earnings going to be in the future? I make a forward-looking call based upon some of the structural opportunities we see. And if I were to make the call that rates in the future will be lower in general than they have for much of the period we've seen in the last 10 or 20 years, well, automatically, let's just take the rate story. All else equal, if rates are lower, then the price that I'm going to get for the same earnings are going to be higher, right? So it automatically makes you challenge, well, what is the fair value of that price earnings multiple in the future? So that's part of the reason why I think we can't just look at PE relative to its past, because it's also a function of forward earnings and forward rates.
You're my best friend, you know that. You're already my best friend. Okay, now to that basket.
You just ditched Shrishti and me.
Sorry, guys.
But you know, sorry, I just have one question. Because India, Vivek, has always been a stock pickers market and a small and mid-cap paradise. You think that is going to change now after this recent correction?
Well,
and you know, when you talk about what to buy right now, it's only financials, which are a purely FII-dominated segment. What are your thoughts on that?
So I think in terms of the large cap relative to small and mid cap, look, I would be calling more about the opportunity in the large cap space right now. I would see the valuation story I was talking there is particularly a large cap story.
Is it also safety?
I think there is, and I think, you know, obviously for not just for the Indian market, but for international investors looking at India, it's an easier asset allocation decision to make to large cap equity than it is to small and mid cap, right, in terms of expertise and so on. So I think that was the first point I'd make. The second point, though, around like the stock pickers dynamic. I think this is a story in India as much as it is more broadly globally. You know, this year is a case in point. The volatility that we are seeing now is greater than we have seen for most of my career. And you know, we were kind of quite vocal in the BlackRock Investment Institute for the last couple of years. We've called it a new investment regime that exists, and that's a new investment regime that I think rewards more active management strategies than traditional beta strategies because of that volatility, because of the dispersion that can occur. You know, we were having a conversation with senior investors just the last couple of days, and one of the comments someone made was the idea that momentum can be now measured in hours rather than days and weeks, right?
Minutes sometimes.
Yeah, well, exactly. So I think this kind of makes the point that, like, for those who can like really see through that noise, there are more opportunities now, and I think that's an India story as much as it is a global story.
You know,
so beyond financials, what interests you about India? Is it going to be more of the same? Because India was last, say, 2 years, a lot of, you know, Make in India, CapEx theme that really did well. Yeah. Is it going to be more of the same, or is it going to be new leaders which are going to emerge?
Well, so 2 points there. So firstly, I think financials, there is an opportunity that would exist here. The sizable chunk of the overall market that is financials, the fact that liquidity dynamics are easing, maybe there's greater credit provision as a result of those liquidity dynamics.
And they've done nothing practically last 2 years.
There's that as well. But then the next point I think is then, well, which companies can best tap into those structural mega forces that are arising? And as I've said already, some of those are to do with that AI transformation, right? As a result of that, I think maybe some of the big winners 5 years out, we don't even know about today. And that's just the nature of the fact that the market is rapidly evolving. So today, I would say yes, financials, but let's be open-eyed to the fact that the winners of the future when it comes to the adoption phase of AI, we might not even know who they are today.
So let's start summarizing our today's interaction. And you know, I just want to put this on record. We had Chris Wood in the morning, Chris Wood at the beginning of the week. We had Jim Walker, and now we got Vivek. All of them are in a sense endorsing that start buying India. Large cap stocks are looking reasonable. It's only the pace of the correction in India has been so brutal that suddenly the Indian investors are not able to understand beyond this smog and fog which is in the short term because of selling. India is not expensive. Your view is that equities in general should not be given a stepmotherly treatment. US in the short term, India in the long term, China somewhere in middle, which could be the medium term. But if you are a genuine long term investor, stay invested in India. You like large cap stocks in India. And from a market standpoint, whether it is tariff or inflation, your firm saw it coming. So it has not come as a surprise right now in terms of how markets are reacting and how noise is building up. Have I missed on anything?
That's a great summary. A couple of points I just really quickly make. So the China story, I think is very much a tactical short-term story. That's the first point I make. And the second point is the inflation rates story. Yes, our core view has been for a period of time the rates will settle at a higher level than the market has been pricing. And we were kind of very vocal with that for a good couple of years. If you kind of compare though, like the market has oscillated around that view. So you go back to the start of last year, huge amount of rates cuts were priced in, then they kind of went away entirely, and then actually the market kind of caught up with our view, and now the market is kind of now pricing in rate cuts again. My view, the firm's view, is that rates will settle at a little bit of a higher level in the long run than we have seen for a generation.
Vivek, so good having you in the studio today. Thank you so much for your time.
Thank you. Thanks for having me on.
Thanks.
If you like this video, then like, share and subscribe to ET Now.